let's see. Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com, PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents, or independent contractors are in such capacities. Licensed financial advisors, registered investment advisors, or registered broker-dealers. Nothing contained in this webinar website or promotional material constitutes a promotion, recommendation, solicitation, or offer of any particular investment, security, or transaction. Trading options involves risk. Visit the OCC website, www.optionsclearing.com, to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not a service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously, and we will not distribute or sell your information to anyone. There you go. All well and good. So how's everybody doing today? Are we enjoying the fun on Capitol Hill? We got the Russell. Look at the Russell. That's from 53 to 71, and that just exploded up higher. The Nasdaq is moving up now. It's only flat, but I mean it looks exciting because it was down. And the S&P is moving up. So everybody's moving up because everybody thinks that nothing bad's going to happen to Trump, and we're going to just keep, the traders like nothing to happen. They don't want anything to happen. They don't want impeachment. They don't want anything. They just want things to smoothly stay the same, and they're happy. And that's pretty much what looks like is going to happen. It's very doubtful the Democrats are going to impeach based on what we have today. I mean, they have grounds for impeachment, but to actually impeach is just a waste of time. Trump's only got like a year left. So why bother? It doesn't make any sense. It'll take longer than that to conduct the hearings. It's really a shame. And then, and anyway, if you impeach Trump, you get Pence. Who wants that? So unless they can tie Pence in, which they certainly haven't been able to do. So unless if Pence wasn't involved and he ends up being president, then that's as bad as Trump. So I don't see where there's no point. There's no strategic point to getting rid of Trump. And in fact, frankly, I don't see, despite a lot of people saying to the contrary, I don't see how he possibly can be reelected. I don't. So, I mean, I think that's what the Democrats are really looking for here, is to just have enough good hard facts and evidence that they can make a good case for people in America. Say, look, at least don't reelect this guy. We won't indict the guy, but don't reelect him. And if they can get away with that, they get presidency, and that's that. But otherwise, I think this is kind of pointless. So that's where we are. Markets are being pointless also. We have the Fed next week, so nothing really matters until that happens. And I think we're pretty much drifting on the portfolios. We'll take a quick look and see if anybody's got questions or some such. What's this? Oh, it's on the right page. So let's see where we are. Money Talk, which is the one we don't touch, that's still 175%. That's about where we left it the other day when we did the review, so no real changes there. Hemboka is doing nicely though. That's I was surprised. I thought it would have been hit harder. It's actually 5.5 now. We took a hit here because the MJ ETF has gone down, and that's because one of their key holdings, Curaleaf, got in trouble with the FDA for it's not a general thing. They made on their packaging, they made claims that were effectively medical claims saying like such and such product does cure this and that. You can't say that. In fact, I just got yelled at yesterday because we were doing some package design for our CBD products, and I said, I said hangover cure. You know, we have this formula that's you know, that's very good at knocking down a hangover. You know, to go for a CBD thing, and you know, so it's that plus some other ingredients that's a good concoction to alleviate hangover symptoms. So I wanted to call it hangover cure right away. They're like, I can't say that. I can't say cure. That implies blah, blah, blah. Well, unfortunately, Curaleaf didn't pay attention to those rules, and they got fined by the FDA. So, you know, you got to be very careful about what you say on your packaging and then be very careful about making claims. You know, it's the same crap we do in the disclosure. We're following SEC rules. We can't make certain claims. We can't say certain things. We have to be very clear about the disclosure. Whereas in on the packaging of CBD products or cannabis products, frankly, you've got to be careful about what you state. So anyway, so a couple of companies, a bunch of people sold down in the marijuana space and in the CBD space that MJ Holdings has, and it's been like this. And also in Canada, where most of these companies are, the public ones, they are seriously overgrown and oversupplied for that market. Long term, I don't think it's a problem, but short term, they have to get their houses in order because they're overproducing. It's a big problem. Now, even, you know, we don't have that problem in the States because, you know, Canada's only got 30 million people or something like that. California has 60 million people by itself. So we have a massive market. So, you know, so I mean, for New Age, our marijuana company that PSW Investments owns, they're moving into CBD too, though, because the market for CBD is just way bigger than the market for marijuana. It's the whole country is basically a market for CBD. Whereas with marijuana, first of all, the biggest problem with marijuana is you have to do it state by state. So in every state, we have to set up a growing operation. We have to set up a refining operation that takes the biomass and turns it into oils and stuff. And then we have to set up a manufacturing facility that turns that into like edibles and gummies and oils and whatever people want. So with THC, you have to, in every single state, have a whole operation. Whereas with CBD, we can have one operation supplying the whole country. So that's why CBD is huge. And in fact, we have a couple of massive orders that are pending, like 2.5 million pounds of what they call isolate, which is effectively a powder that will go into beverages. We have that from 2 different companies to supply for beverage concoctions that they're making and putting on the shelves. There's huge deals being made all over the place like that. We're just having, you know, we're one of the guys in the business, so we're getting those deals. These are multi-million-dollar things that we're doing. Hemboka is a CBD company that PSW Investments owns as well, and that company is also, you know, it's a slow process because of all the approvals and the FDA and all that. But our manufacturer for Hemboka just got 4 FDA approvals. We're the first 4 FDA approvals in the country for 4 different products that we put out. So we're the only ones that are actually now certified by the FDA. Though I'm sure many people have pending approvals, we just happen to get the first 4, you know, mostly because we've just been doing it a long time. But we'll be able to run off of that for a while. In fact, we have a very big deal. Because we have these FDA approvals, we may actually be able to start selling in airports, in vending machines. So that's going to be also a huge possible deal for us. So it's really exciting. It's a very exciting field. So anyway, bottom line is, though, there's so much money in these things that it's just a question of grinding out the agreements and getting stuff going. And what they have here is just overcapacity. And that has to settle out, and then they can start actually making money. You also have idiots like MedMen who got $250 million and they run right out and buy a store on Fifth Avenue that cost them about $5 million a year in rent, just one store. And that's they were gambling that that marijuana would be legal recreationally in New York soon, and it wasn't. That was 2 years ago. And so now they're paying, all they can do is sell to people who have medical marijuana licenses, which is very, very few people in New York. And of course, there's more than just their store to choose from. So who's going to haul their ass all the way to Fifth Avenue just to buy the medical marijuana stuff that they can buy almost anywhere? And especially pay those prices that they're charging. So they're wasting tens of millions of dollars on a location. They've also got a location on in Rodeo Drive and probably 10 other expensive places that are stupid. You know, they went for high profile exposure spots, but they're losing their asses. They're just draining money. So it was a stupid concept. They never did that. New Age, by comparison, our New Age company is still in the same Maywood, Los Angeles. It's like a warehouse district in Los Angeles. We're still in the same little place we started in. We just bought the neighbor next to us and knocked out a wall. Now we have a bigger facility. And we opened up another one way up north in Desert Hot Springs, which is also cheap land and cheap area and all that. We don't need to spend the money to distribute. We just distribute to the different dispensaries. But we don't need to have a dispensary. We don't need to have a high profile store in LA. Why take these risks? You know, but that's the problem. These companies that go public is they want to have these high profile exposures, and they overspend and overdo, and then they acquire people because they can't figure out how they're going to grow themselves. So they buy someone else and they pay too much for the person they acquire. So these are all reasons where this thing could end up sucking. But I think even if we go down to 25, I think we're going to stabilize around here and then head back up, because I think it's just a problem in the industry that will resolve itself after a couple of people go bankrupt, and then the ones that are left will start like cleaning up on the business. So it's an interesting industry. I really like it. So what else is in our hemp? Whoops, didn't mean to do that. Go away. What else is in our hemp Boca portfolio? We have IMAX. IMAX is going nowhere, still playable. We have Macy's. Macy's just started taking off, and we have Molson Coors also just started to take off. And this is pretty good. I mean, if you consider that we did this trade 6/18, it's now 7/24, so basically a month. And in a month, we're plus $1,750, and our initial investment was, let's see, 17123. Whoop, why are you not working? 17123 minus 12250, so 4750. So from 4750 we've made 1750. So 1750 divided by 4750 is 36%. So we made 36% in our first month on this trade. Now, what's the potential on this trade? It's 20 times 10 is $20,000, and currently it's 19.4 minus 9.4. Well, I could have done that in my head. Minus 35 is 6,500. So there's still 13,500 left to gain on this spread. So even though it's already made nice money for us, still has 13,500 left to make, divided by 6,500. So 200, still can go up 200% if TAP hits 60. It's at 56.62 now. All right. This is the thing, because a lot of times, you know, people have been saying, you know, why don't you start a new portfolio, or so on and so forth, or, you know, why, you know, you want to reset the portfolios. I say, fine, I'm good. So we had an excuse because of Hemp Boca and doing their radio show that we could start another public portfolio. And I like doing the public one because it allows me to, you know, point to it and say, look, these were all live picks. There's no trickery here. It's like this is how we do it. We pick these stocks and then we go into it. No big deal. Now, I want to start a live small portfolio. It's only $50,000 from scratch. But the problem is that here you are, when 1 month later, it's already up 5.5%. 1 month later, this thing's already up 36% this trade. I can't help that. You know, it's in other words, anytime we have a portfolio, we'd have to have 100 portfolios to make everyone happy that we're constantly every week starting a new one. Because they make money. If they make money, they get away from you. Then you feel like you can't get in. But you can, because every trade, you just have to. The key is to think about the balance of your portfolio. So this is hemp boca. So we were looking for some sin stocks. So we like MJ, the marijuana ETF. We like Molson Coors because they're getting into the marijuana business. They're making a partnership where they're putting not our products, unfortunately, but somebody else's product. They're putting isolate into beer, and they formed a joint venture with one of the cannabis companies where they're developing a system. Now the problem with beer and the problem with soda, it's the same problem, is that the CBD can break down because of the carbonation and everything else. It can break it down. So you have to create you have to harden the CBD encase it in things or whatever, and create a system whereby you're delivering the same quality product 3 months later after it's been on the shelf that you would have had when it was fresh in the can. That's a little tricky, and so they're developing that. We're not developing that. We're just looking at it. But anyway, so we like TAP for that reason. We thought it was a good project to work on. If they solve it, it can make a lot of money. Macy's, of course, I keep banging the table on big bargain stock, and IMAX is a theater. So we have a marijuana company, a beer company, a movie theater company, which is fun to watch while you're stoned, by the way. So there's a theme here. And Macy's was just honestly because it was just a huge bargain, but also because it's diversified. And that's the point. In other words, we talked about the top trades last week, so I'm not going to get back into it too heavily. But we always have top trades. We always have picks on the site. And hang on, because this bar is in my way. You guys can see it. You know, and IMAX was a top trade anyway. We always have top trade ideas. The trick for a portfolio when you're building it is to build it out of build it from things that diversify your holdings. You know, don't have too much tech, don't have too many retail, don't have too many consumer products. Make sure you have a good mix of items. You know, something from all the sectors, and make sure you have a little bit of hedging in too as it matures. The hemp boca portfolio is too small to hedge. It's just starting, so there's no reason to hedge it. If we're wrong about the picks, we're wrong. We pull the plug and try again. But you start hedging if you have something to protect. So when we're up 10, 15%, we might start hedging a little bit, but we don't want to jump into it too quickly. But the point being, anytime you can start a portfolio. The more important thing I want you to pay attention to when we're doing these portfolios is how slowly we build a portfolio. So here we have $43,000 of buying power remaining in this portfolio. We're very, we do this all the time. We very slowly add things. First of all, we have 4 positions now. We had one on 522, one on 618, one on 79. So over the course of 2 months, we picked up 4 positions. And first thing we do is wait, and pretty much wait an entire quarter until we see that we get through earnings and that we're satisfied with where we are with these positions, that we feel they're on track. If they're not on track, we have to either cut them or we have to adjust them. And we do that first while we still have spending power before we go and buy more stuff. So right now we have a ton of spending power. So if we decide something's not working out, if we decide something should be better positioned, like MJ is probably, we're going to adjust the positioning, then we'll see where we are after we do that adjustment. All right, and most likely in MJ, my adjustment would be, let's take a look. So with MJ, we have the 202125s that are $7. Is that correct? The 25s that are $7. And the 35s are up 50%, but that's not worth taking off the table yet. So we have the 25s. Now, do we want to roll into the 20s? Well, the 20s are 10, 990 and 1030, so 10, 10, 10 or something like that. So, and these guys are 7. So it costs us $3 to roll down $5. That's kind of attractive, but what's the cost of that and what are we going to do with it? But I think I would rather, if I could, double down. So if we bought 10 more at 7, that'd be $7,000. But then we could sell, let's look at September because August is too close. If we could sell the September, nope, I don't have the pricing. See, if we sell September 30s and make money, but we could though because we don't have any sales. So here, that's actually true. Let's see, 5. No, it's only $1. So even if we sold 5, it would only be 100. No, can't do it. So there's no good play right now for us because we can't raise enough cash selling calls to really make it worthwhile. Let's take a look at what January is. January 30s, these aren't so bad. If we sold 10 of these, but then we'd only have 10, but they'd be uncovered. Okay, so possibly, and I'll think about it, it's not a definite thing, but let's say we sold 10 of these and raised $2,300, right? Of the January 30 calls. It's right on the money. It won't matter though because we double down. So we have 10 of the 2021 $25 calls that are covered by the 5 short 2020 calls. Now, so the question is, if MJ goes higher, we'll have to roll these calls, which are 30s, which are 220 or 230. So we have to roll those calls, which are 230. We'd have to roll them to, let's say, probably the 38s, or whatever, the 40s are almost $2. So let's say we have to roll them to the 40s. So then we'd have a 25-40 spread. There's nothing wrong with that. I think that's the spread we have now. No, we have the 25-35 spread. So we have the 25-35 spread. For net of $5,000, we can add 10 more of these. So that's why doubling down is better, because we'd have 10 more of these, and our worst case is we'd end up with 10 more spreads and we make $10,000 more dollars. So if it goes higher, we'll make another $10,000 back on our $5,000 investment. So that's pretty good. And again, you have to take into account how big is the portfolio, how much you want exposure. But what we're really doing though is we're setting ourselves up for multiple sales, because if MJ fails, this is more important. If MJ fails to be over 30 by the end of the year, we can then every month sell at least 10, or every other month or whatever, we can sell at least 10 and get $1,000 back per month. Okay, and since we only spent, calculator, since we spent on this MJ spread, we spent 10.5 minus 58.50 minus 3,175. So we only spent 14.75. So if we end up turning this into a trade that for plus 5,000 at the moment, it would be cost 5,000 more dollars. So for 64.75, we would turn this into a trade where we have a reasonable expectation to sell another $4,000 at least each quarter next year. We'd sell another $1,000 per quarter of short calls. That would bring our cost back down to 24.75 for the spread, and it's a $20,000 spread. So on the upside, we'd be in a $20,000 spread for not much more than twice the money. And understand that what we're talking about though, I'm saying that what would happen is if we're spending $5,000 now, we know we spend $7,000 to buy another 10 of these 25 calls, and then we sell 2,000 short calls, the January 20s. That's not reflected here. We sell the January 20s for 2,000. So our net spend here is 5,000. That brings our net spend for the total up to 6,000. Well, here you go, plus 5,000. So our net spend is $64.75 on a $20,000 spread. So what are the things that could happen? It could go higher, and we would have to roll our short calls up. The short January 20s, which would be new, would be rolled to the 20, 21, 35s or 40s or whatever. All right, but at least a $10,000 spread. So if it goes up and we're in the money and we're buying a $10,000 spread, we're in good shape, and we could still sell $1,000 worth of quarterly short calls along the way. So we can expect to reduce our cost by another $4,000. So we pay down to $24.75 on what would become a $20,000 spread. That is the upside case. On the downside, on a flat case, what would happen? On a flat case, the short calls would expire worthless, and we're into the same scenario. We'd still have 20 of these. We'd have 10 short of these ones, but we'd be uncovered on 10, and we could easily sell 10 tighter. You know, instead of selling ones that are out of the money, we could sell ones that are at the money for $2,000 each quarter, and we'll pick up $8,000, which will also pay for the spread. So that's also a positive outcome. So that's a non. So we have two outcomes. If it's flat, that's fine with us. If it's up, it's fine with us. Now, what if it goes down? If it goes down, obviously the new calls, the short January 2020s would go worthless. We would then aggressively sell 10 more calls, and we're still going to reduce that same cost of the spread. So if it's going down, we're going to reduce the cost of our spread. If it goes up, if it's flat, we reduce the cost of our spread. And even if it's up, we're going to reduce the cost of the spread. So either way, we're going to have a very reasonable spread cost net. So we're investing $5,000 more now net, but down the road, we feel it's going to pay us back at least $4,000 plus whatever the long calls are worth. So the only thing left to do then would be to go look at each individual component in the MJ ETF and figure out if we still believe that the entire ETF is well invested and positioned for next year. And that's a whole nother homework assignment. But anyway, that's just me going through my decision process. And the funny thing is, though, in the end, I'll end up writing something like "on track." You know, like I'll just like write a little note in the thing after I do all that work. But that's what you have to do. You have to look at your portfolio and think about like, okay, if I do this, what's a reasonable outcome for me to have? So in other words, so it's less appealing to roll down to widen the spread, because widening the spread doesn't really put me in a better position to sell short calls. Whereas adding 10 more of the same strike here, since we're still in the money, allows me to make more sales that'll get that money back fast, that'll get that money back in a more sure manner. Because if I roll these down to the 15s or whatever, if I roll these down, I'm sorry, to the 20s we were looking at. If I roll these down to the 20s, yes, I'm only spending $3,000. I'm widening the spread by $5,000, but I got to cross my fingers and just hope the spread plays out. But if I double down at 25 and now I've got 10 open slots to sell, I know that I can generate back $4,000 next year. I can easily sell $1,000 worth of short calls every quarter next year and get most of that money back. So I'm laying out a little bit more now, and it's cheaper later. Now, and then let's take into consideration, am I making enough extra money to move the needle on the portfolio to make it worth me making this a larger position, to make it worth me adding to concentrating my risk a little bit more in the MJ ETF? And the upside is another like $9,000, which is 20% of the entire portfolio. So yeah, sure, this is kind of worth it. And also another positive about the MJ ETF is it's not necessarily tied to the broader market. It's doing its own thing. It's not necessarily going to crash out when the rest of the market crashes. It's like a SIM stock. It's not really tied to the broader market. It's a new industry. It's still got a lot of growth to go, and it has huge premiums to sell. So many good positive reasons to use that position. So anyway, all that goes back to, this is why we start off slowly though, because you want to really, as the first quarter progresses, you want to see how everyone's behaving. and watch the earnings. Obviously, these guys have no individual earnings. We have to watch each company in the ETF. You want to gauge your earnings reports, look at the outlook, and think about where you're going to be and whether you're deploying a appropriate amount of capital to each position, and whether you might. And also another consideration, by the way, though, is do I have something better to spend $5,000 on than that? So in other words, in lieu of buying a whole new position for $5,000, I'm going to say to myself, what do I have that's more likely to make $10,000 back if I spend $5,000? Do I have something that's more likely to double $5,000 than adding to that particular ETF? And again, though, I have to say, not really, because I like being able to sell. I like the premiums in that ETF. I like being in a position where I can sell a lot of premium in that ETF. So it's very appealing to me from that perspective, that I have control of my destiny by selling premium. So I'm not locked in. So there's, so there's good reasons for that. Now, of course, you can also talk about, like, well, how about cut it loose and not even deal with it? That's also a thing. But then it goes back to, well, what else would I put this money into? What do I want to put this money into that's better? So I still like it. I still think it's valid. I think it's going to have some rough times ahead, which means it's definitely a good idea to sell some short calls. And we can pick up some good money. We can pick up $2 a share selling the January 30s. All right, and they can't hurt us on the upside, and so there's no reason not to sell them. So that's pretty much where we're going to be heading. But again, there's no emergency here, and I'm not running into it. And if I wait, by the way, there's another point to the strategy. I'm saying this now because we haven't been talking about it now. But meanwhile, we're not making it. We just made a portfolio decision. We decided not to do anything about it. Well, we haven't actually done anything, but we just did our portfolio review for Hemp Boca. We didn't make any changes. And I'm going to wait out earnings season and see where these companies go. Now, what if earnings are great and it takes off? What if somebody has fantastic earnings and the whole ETF takes off? Well, then we're going to make the money we thought we were going to make. We only paid like net $1,500, $1,700 for the spread. It's a $10,000 spread. So if it gets away from us, quote unquote, right? If it gets away from us, we'll make $10,000, okay, or $9,000. So what? That's fine. I'm not gonna sweat over that. Then we move on and find something else to trade. So there's no emergency either. That's another thing. All these are factors you have to consider when you're looking at positions. There's no hurry to act. Let's get more information. We don't need to rush into this. We just are thinking about our fallback plan on this position if it goes lower, and we don't mind the worst case scenario. Therefore, there's no reason to pull the plug or do anything, frankly, at the moment. So do we need to pull the plug on position? No, because we have a we're very happy to double down and play it out. So we don't need to pull the plug just because it's down a bit. But we also don't need to double down just because it's in a low place on the channel, because it might go lower and that would make it cheaper for us to double down. Wouldn't change the premise any. And also we have plenty of time. We're not worried about it. We have a lot of outs. So we stick, it's like poker. We have a lot of outs, so we're going to stick with the hand that we have because it's a good hand. We're going to keep betting it. Well, but unless it becomes too rich for our blood. But that's what we do when we're early in a portfolio. You have to every position, every single position should be analyzed like that, and you need to think about what you're doing. Are you on plan? Do you have it? What are you on track? What are you going to do if it goes up 20%? What are you going to do if it goes down 20%? And something most people forget about: what are you going to do if it goes flat? How are you going to make your money? Do you know how you're going to make your money on this position? Do I know how I'm going to make my money on IMAX? Sure, it's already at 21. It only has to hold 21 and we make all of our money. So that's a $4,000 spread that we pay pretty much zero for. What's that? $3,500, $700. We paid $700 for a $4,000 spread. That's right on track, and I don't think IMAX is going to be lower in January. So we're done with that basically. Macy's, longer term spread. It's a $7,500 spread. It's halfway in the money. It's just starting to kick up. We aggressively sold the puts and we're already at our target, and we paid zero. Actually, almost exactly zero for a, wow, I think it is exactly zero. We paid exactly $0 for a $7,500 spread. This one's nicely on track, no problem. MJ just talked about, we know what we're going to do with it no matter what it does, so we're happy with that position. And TAP also on track, halfway to our goal already. We have another year to go. And this is a, what's this, 12, 5, 45, about 4750, 4750 position. That's good for $20,000. And that one's on track. So there you go, boom, that's that portfolio done. But you've got to be able to do that. I mean, at least, in the very, very least, once a month, you have to go over your portfolio like that and say, this is how all these positions are. Are they on track? And if they're not on track, you've got to fix them. Can't just stare at them. And that means, since you know that's the case, that means that you always have to make sure that you're not boxing yourself into a corner with margin and stuff like that. You've got to have the money to fix your positions. So you have to think to yourself, what do I do if everything goes down 20%? What do I do if the market crashes 20% and I don't have time to react and deal with it? All right, and a lot of people say, especially people who aren't members, like on Seeking Alpha, I get this a lot. People will say, why do you have such big hedges? Because, you know, the market has break limits at 10% and whatever. Well, first of all, after 9/11, the market was closed for like 5 days. So it opened where it opened. I don't think the 10% down thing holds in that case. Plus, what happens with the stop limits in the market is the whole market goes 10% down. They'll stop trading if they can't resolve it that day. They're done for the day. Then the next day it opens, it can gap down 10% again. I could go down 10% the next day and be 30% down, but that's, you know, it's less and less likely. But I really feel strongly that you need to be prepared for a 20% drop. That you've always got to have that possibility on your mind. That you come in tomorrow and everything is 20% lower than it was today. You know, if any city in the world gets nuked, that'll happen. You know, any kind of, you know, a lot of kinds of terrorist attacks that could happen, major terrorist attacks that could happen. These things are not off the table. So you've got to have a plan. You can't not have a plan. It's kind of irresponsible not to have a plan for what you're going to do. And I'm not saying you should be constantly worried about it, but it is realistic. Now, in the case of the short-term portfolio, that becomes a function of how much money the long-term portfolio makes. The more the long-term portfolio makes, the more we hedge the short-term portfolio. Long-term portfolio is making outrageous amounts of money right now. So the short-term portfolio is down to 610%, which is 710,000. I forget what it was the other day, but it was less than that. But the long-term portfolio is just kicking ass. Well, I know where we were. We were right about exactly 1.2 million. Oh my God, 224. That is sick. I mean, that's some crazy number. 1.6 million. So now we're at 2.3 million. We gained another $100,000 since the weekend. I mean, that's just crazy. Because we just did our reviews we just did the long-term portfolio review on Friday. What were we on Friday? That's nuts. So this is untouched, basically, in the long-term portfolio. Tuesday, no. Boy, I write a lot of stuff. Somebody's saying Mueller wrote 3,500 words. I'm like, yes, so what? Yeah, I write that. Well, I write that every week. That's a big deal. Let's see. All right, here you go. So it was 157 on Friday, the long-term portfolio, and now it is 1623. Oh, 50,000. So it's up $50,000. It seems like a lot. Well, 50,000 is a lot. All right. 1547. 163. All right, 80,000. So it's up 80,000 freaking dollars. Now the short-term portfolio lost, I forget, well, maybe $20,000, but that's fine. That's exactly what's supposed to happen. So between the two of them, though, they're making a new all-time high. So the short-term portfolio, so you see the short-term is easy to figure out. It's 710. So the short-term is down to 710. Money Talk, we already looked at that. I think Money Talk is still where it was, pretty much. Yeah, 176, up a tiny bit. Butterfly, what? No. Oh, no, Butterfly has June and July, so that has to be adjusted, so that doesn't count. Can't go by that. And the OOP, also probably a funny number. Yeah, that's crazy. I think. Do we have any June and Julys? Yeah, we do. See, Apple, the short calls, so they would have to be, if there's a charge back there. DXD, we had those expired worthless, so that's correct, actually. Did the Apple short calls expire worthless? Apple, where was Apple? Did Apple expire at 200 or was it over? No, it was over. When did we end? We ended on the 19th, right? So 259. So that's how much would be charged back. So the actual expiration was 259, and I haven't logged the adjustment yet, so it's showing 0 at the moment. So that would be $2,590 difference there. DXD is a July. That might be it. Oh, that's not a big adjustment. That's the only, so unless I'm missing something, which I don't think I am. No. Wow. All right. So really just minus $2,000 here for the options opportunity portfolio. Wow. That's put up some big freaking gains. Why is that? What makes so much money? I don't know. Somebody did. Well, Apple went up, obviously. So Apple went up and this thing expired. So that was actually good. I'm sure we sold something else, but let's see. ALK, Excel, BBY, but no, BBY didn't explode up. City had good earnings. That's true. Chesapeake, yeah. Huh, interesting. FCX. Look at Freeport. The Freeport had a loss and they went up today. Everybody's very happy it wasn't that bad of a loss. GNC, HBI, Intel's chugging along. Kraft has still got its problems. Coffee ETF, also problems. Macy's, we said, is doing good. MJ not doing good. MU doing great. Oh, I guess most of our stuff is doing well. It's green and in good shape. So I don't know. It's just grinding higher and higher, though. It's crazy. The market is really delusional. But what can you do? I mean, it is what it is, right? Nobody has any questions. Look at you guys. Okay. I'll just keep blabbing along then, I guess. See how we're looking. How's the testimony going? All right. So the Dow is still going down. Everybody else is up. So Dow's is really getting dragged down by a couple of things. So I wouldn't count that. I wouldn't say that's a negative. The Dow's being dragged down by a couple of components because it's a stupid index, and all it takes is a couple of components to do really badly, and the Dow has a bad day. And I imagine Boeing can't be doing too good today, right? BA. No, they're down they're down a lot. They're down $10. So that's 80 points on the Dow right there, at least 85 points. That's Boeing and somebody else on the Dow was having a bad day, I think. I forget who. Caterpillar. There you go. Look at that. Brain still works. Holy shit. Caterpillar's down almost 5%. That's terrible. Now we have Caterpillar. See, now we have to think, is that an opportunity for us? Because we have Caterpillar somewhere, and I'm guessing it would have to be, oh, it could be in the OOP. I hope not. That'll be hard to fix. What are you doing? What are you doing? OOP. I'm thinking we might have sold short puts, but we did not. And we have no Caterpillar. Okay, good. Now in the short-term portfolio, we might have sold a short put. And we did not. Okay, oh no, we have a position in Caterpillar though. So we have a 130, 140 spread. Still up actually. So the question is, what do we want to do about it? We don't have to do anything. We're going to watch and wait. But we only sold the 120 put, so don't feel like we're in any particular danger. Although when something falls 5% in a day, like Caterpillar is, that doesn't mean you're done falling. Okay, that means you want to see if it's going to bounce. So basically, the 130 was like the 5% line, and we bounced off the 5% line. So weak or strong bounce. If it's a weak bounce, and we finish the day below the weak bounce line, close to the 130 mark, probably going to have follow through to the downside. But the thing about the Caterpillar is it's all trade based. It really is. It's really mostly a China trade issue. So it's nothing I would hold against the company long term. So I think that on the whole, it's more of an opportunity. So if it does keep going down, we'll just add to the position and roll it. So there's, so that doesn't mean we make an action now because we don't know how low it'll go. And again, what are our choices? Our choices are we abandon the position. No, don't see the need to do that because we only have the 120 puts. We're comfortable with that. We have the 130, 140 spread. We're at 130. If anything, I'd be more inclined to roll down the 130s to a lower strike and maybe sell some calls, but probably not even sell some calls. These guys are not even worth buying back yet, right? The short calls aren't even worth buying back. In fact, we're down still on the short calls. So, this Caterpillar's come up quite a bit from where it was. And we have the 2021, very important, we have the 2021 puts and the 2020 spread. So what we will probably do is roll these to the 2021s while they're cheap. That's almost a no-brainer to do. So while it's cheap and we're up anyway on these calls, we have a chance to buy another year of Caterpillar. Now, given 140 in January, we might actually leave those short calls and pick up a spread to a 2021 spread and use those calls for short calls, maybe put a stop on half of them or something like that. But 140 is looking a little bit harder to obtain now for Caterpillar between now and January. So that might be an opportunity for us to reposition them. But in no case are we getting out of Caterpillar, and in no case are we in a hurry. So just because we can do something doesn't mean we are going to do it. It just means we like the idea that it could present itself. We're going to wait and see where Caterpillar settles before we start running in and making changes. In the long-term portfolio, you have 5 short Caterpillars here. Does that mean we don't have a Caterpillar position? Oh, that's interesting. So I guess we thought Caterpillar in the short term was going to do well, and we did a short-term portfolio position, but now we got burned because we held it too long. So I'm not sure when we bought this Caterpillar in the short-term portfolio, but apparently it was there because we thought it was going to be volatile and we were waiting to put it in the long-term portfolio. So yeah, we did this in May. So in May down here, we got into Caterpillar and we had a good entry on that bull call spread, and it's gone up since, but now it came back down. But our goal was 140. And we got cocky into earnings and we held it. We could have cashed it out for a better price. But we were cocky into earnings even though we were at the top of the channel and we're paying for it now. But that doesn't mean we don't want a longer position. It's just probably what we're going to do is put the longer position in the long-term portfolio, and the short-term portfolio will maintain the short. In other words, we're going to cash these out for $35.50. This is why the short-term portfolio has so much cash in it, because this is what we're doing. We're going to cash these out for $35.50, right? And that'll drop $35.50 to the cashier. We're going to leave the short calls and the short puts in the short-term portfolio. There's a very good chance they'll both expire worthless at the end of the year, and we'll pick up another $17,000 in cash. So if these things work out, we'll be plus $17,000 here. Actually, it wouldn't be added to our cash. It would increase. It would just drop to the total value, because the cash is the cash. We already have the cash in our account. What would happen here is the value, because right now we have a negative thing on the value of $17,000. So if they both expire worthless, but we're going to move this position, so we're going to sell this. We're going to move to a 2021 spread in the long-term portfolio, and we're not going to sell any short puts in the LTP unless it expires, and we're not going to sell any short calls in the LTP, because if the short calls in the STP end up burning us, we would then roll those to the LTP. So interesting. So that's where we are. You have to realize we trade these as combined portfolios, but they're not all on the same sheet, so it's a little tricky. You have to learn to think that way of how it's set up. Let's see what else. Burton's asking, thoughts on CLF earnings? They seem to be on track for significant improvement next year. What's your price target on them? CLF. Well, we have CLF in, it's got to be in the long-term portfolio, right? We have it here. So in the long-term portfolio, our position on Cleveland Cliffs is, here it is. That's very straightforward. We have the 8-12 spread, and we sold the 12 puts. So obviously, I'm strongly. Now we sold the 12 puts in June, and this is a strategy also that confuses people. So we'll talk about that. Okay. So in June, I'm not sure when in June. CLF June 4th, so we're very early, first thing in June. All right, so June 4th, right about here, we sold the $12 puts to pay for our spread. So in other words, on this date back here, I said my target was 12. I said this stock is worth 12. Therefore, I don't give a shit where it is now. I'm selling $12 puts. Those puts we sold for a lot of money. We sold them for $4 because we were in the money. We were $9, so we sold them for $4. Those funded $8,000. Those funded, in addition to the short calls that we sold at 12s, funded the entire purchase of the 18 calls. So it's there's also a $20,000 spread that costs net zero in the long-term portfolio. Is an aggressive way to get there because we sold these very high puts, but we sold them because we firmly believe that 12 is a good target. So nothing about that's changed. They're just doing exactly what we thought they would do. So to me, the significant improvements next year are going to put them firmly at 12 or higher. But I mean, my target for them is this. And also, you got to realize, even now, this spread, which is a $20,000 spread, is 19,375 minus 9,700 minus 5,890. Oops, wait. I can't see that. All right, 37.85. So even now, it's only 37.85. So we're up 37.85. We paid net zero for the spread. Where is it? Oh yeah, there it is. Okay. Yeah. So we paid net zero for the spread. We're up 37.85. But so what? It's still got $20,000 to go. So minus $20,000 is $16,215. And what we say, 37.85, 3785. So this spread is going to make 428% if CLF can hold 12. So what do you need to do? Why would you have a more aggressive target than that? And you're not really saying that. You're saying, what's my target? I'm saying I don't give a crap how much over 12 it goes. I'm satisfied with 12 as a target when I can make 400% back on my money from 12, at 12. I don't care about, and that's the thing. You know, a lot of people ask those kind of questions. What's, you know, these targets, this high target, blah, blah, blah. Oh, CMG, we should talk about. I don't care if my target is what I think it's going to reasonably get to, that I have a fair certainty it's going to get to. Therefore, I can play it aggressively. Do I think it can go higher than 12? Absolutely. It can go to 15. It can go to more than 15. But I don't need it to go to 15. Even now when it's at 11, I still think 12 is fine because I can make 428% in 18 months just playing the same spread right here. It would be foolish to take a bigger risk than that when I don't need to. And that goes for a lot of things we sell puts in. Oh, look at Celgene. Celgene is really annoying. It's getting cheaper and cheaper because they're doing the merger. And for Celgene, you get $50 worth of stock. I'm sorry, you get one share of stock, and then you get $50. So unfortunately, we're tied to the stock movement, which is very sad. Unfortunately, it's not hitting our target, or it's barely hitting our target. We have an $80 target here, and we have an $85 target here. So we're getting closer and closer to being worried about this trade. I think it'll hold up though. Now, CMG. Let's see. Do we have another one up here? We do. Look at that. We sold more puts over here. So, okay, we don't worry about the puts. But how much trouble are we in based on today's move? Because CMG is a nightmare for shorts. We have this problem in the hedge fund too. We also have a short calls in the hedge fund. They're at like 775 right now. They're up 5%, 5% roll. They're up 5%, $36 for the day. And our position on CMG, and again, there's no rush to change things, but our position is we have a bull call spread here that's in the money. It's so in the money though that we're basically just waiting for it to be fully funded. It's only $110,000 now, and it's $120,000 spread. So really, we're about at the point where we cash it out. $110,000, and the most the spread can make is $120. Right, 60, yeah, $60 times 20. So the most we can get is $120. So why tie up $110,000 that can only make $10,000 more in 18 months? That's a foolish use of money for us, because we know we can make a lot more than 10% on $110,000. There's literally dozens of things we could do with the money rather than leave it in that position. So we're now done with that. Leaving us with, and by the way, this position started out at not even 50, 47,000. So 110, it's a lot. 110,000 minus 47,000. What? Oh, times 110 minus 47, 63. So we're up $63,000 there. Okay, good. All right, so this spreads up $63,000. The short puts, obviously, are going to go worthless. But here we can make 50% of the money. There's no reason to take those off the table. Then we've got the calls, and we have the 700-800 spread covering the 740 calls. We sold the 740 calls for $76 though, so it's not really a problem. We're actually not in bad shape on this, and I don't know if we made other changes. Let me. Well, that will be here in the long-term portfolio. So Control F, CMG. Nope. Okay, crazy option pricing. We were at 95.8 on Friday. So now we're at 110. So it's time to take it off the table. See the difference? We were at 95.8. So for $25,000, I wasn't going to cash these out. But now it's only $10,000. It's not worth it. It's not, I go even 25,000. It's 25% of 95.8. That's worth making 25%, especially when it's on a sure thing that was totally in the money. But now it's $110,000. Why should I keep it? Now I've made 3/4 of that, or 60% of that 25,000 potential has been made in a couple of days. And now we've had to wait all year for the rest. That makes no sense. Not worried about the short puts, and look how expensive they are. They're still expensive. And we added the 700-800 spread to cover the 740 calls. So that was smart. We did that, and we did all this like a week before I wrote this report. And now we're waiting to see what happens. So that's where we are. So we're actually in very good shape. We're probably in better shape here than we are on the hedge fund. Because we had those short calls for a long time in the hedge fund. But it's the same solution though either way. All we're going to do is buy more in the money bull call spreads. So in other words, I spent what is it? 165. 165 minus 114. 50,000. So we spent $50,000. No. 232, 950 minus 165, 123. Sorry, 67. We spent 67,950 on $100,000 spread. So we got 33,000, about 1/3 in coverage. So we're picking up. So this spread will gain 50%. Oh, it's more. Okay. I'm sorry. It's not. No, it's not a $100,000 spread. It's a 15 contracts with 150. So that's actually pretty good. So minus 150, 123. $82,000. That's a good spread. Okay, so we're going to make $82,000 on that spread. That's coverage on these short calls. Oh, yeah, these short calls right here. So that's coverage on these short calls right here. Not to mention we sold them for $76,000, for $76, $126,000. So they're fully covered. But the bottom line is, what I'm saying is here I spent $67,000. And I can make 82,000. I make more than 2 to 1 on the money. So what's my worst case scenario? I'm going to buy another double, another spread that will double, and another spread that will double. So if CMG wants to keep going up and keep burning me on my short calls, and every time it burns me, my spreads that are going to make 150% go in the money, I don't care. It's not hurting me. It's giving me an opportunity to buy more and more and more. And that's why we have such a, and frankly, this position here, look where we started at 480. We bought CMG when it was under $400. This all started. And we keep buying more and more and more longs to cover the short calls that we keep rolling. But we're not taking a loss. That's why the reason we have these gigantic short call position, $126,000 short call position. The reason we have it is because that's the accumulated losses along the way that we keep rolling to longer and higher positions. And frankly, I don't give a shit if we're in the 2022 1000s. I mean, this is only 2020 anyway, but we could be in the 2022 1000s. I don't care. I don't care how high CMG goes, because every time it gets a little higher, we buy another bull call spread that's in the money, and we put stock so we cash out the previous bull call spread that already made us a ton of money. So we're getting cash and cash and cash and cash. And if one day CMG goes down, we might finally lose money on one of our bull call spreads, but we're going to make but we're going to make more money here than we spent on the spread. It's a great system. Now the problem is, though, if you don't have the margin for it, you end up, you can get into problems with these kind of trades. But as long as you have the margin to do it, it's a fantastic way to go. And of course, the hedge fund has the margin, so we're pursuing the same thing. And I know in the hedge fund, the short calls on CMG are probably down about $350-something thousand, $400,000. That's, that can swing the fund like 10%. But that's so right now it's carrying as a loss in the fund. But one day CMG won't go up another 10% every time they have earnings, and we'll cash out, and then we'll suddenly have about $400,000 positive. So it's the same thing as the LTP. It's like the fund is in the same position. It's everything. It's generally doing great. We're making a fortune, but there's this one thing that's dinging us basically. But eventually it'll pay off. And by the way, it's also a hedge, right? Because if the entire market pulls back, CMG is not likely to be immune. So in the case of the market dropping, it's good to have some things like this outstanding because all of a sudden those cash you in. And that's in addition to the short-term portfolio money, we end up picking up this cash as well. So all good on the whole, and obviously you can't. Yeah, we made $80,000 since Friday in this portfolio, so it's hard to argue. And that's including, by the way, any additional losses in CMG. So I mean that's what I mean. And there was you could say, oh gee, we would have made $120,000 if this hadn't happened. I don't care. Would have made 120 instead of 80, but it's not. But down the road, though, if the portfolio takes a big hit because the market goes down, all of a sudden this 126 will drop to the bottom line. All of a sudden that becomes a giant gain. And that's part of being diversified too, is having positions that pay off in either direction, not only having positions that pay off in one direction. Now, in 2007, we had a short list. We were shorting a lot of stocks, and not necessarily a straight short, but we'd have a bear call spread. We'd have we'd have a bear put spread, or we'd have short calls, or we'd have actual outright put plays on things. We had a list of things we wanted to short. We don't even have a list right now of things we want to short. This is just basically, it's an unshortable market, just like it was in 2009. In 2007, I didn't consider the market unshortable. I couldn't believe it kept going higher. This market is more like 1999, where it just goes up and up and up, and you really shouldn't call it or try to call a top. You just have to ride it out and let it make you money until it stops making you money. Betting against it is very frustrating. But what's going to happen to us is, it's fun to say, oh great, our portfolio went up $82,000 this week, but eventually we're going to take a $150,000 hit. It's going to happen, but to some extent that cash is our hedge. The money we're making is part of our hedging. You have to just accept the fact that it's unrealistic. If you don't want to accept that fact, then cash it in. And believe me, I'm so tempted to cash it in. I want to cash it in. It would make my life so much easier to cash it in, but I'm trying to just go with the flow as much as possible. But we have this gigantic amount, $600 and something thousand worth of hedges in the short-term portfolio, plus things like CMG, another $100,000 here of short calls, other things in here of short calls that have money. So we're talking about, we have almost $1 million worth of hedges of things that'll make money on the way down. And the grand plan of that is that we make $1 million in our hedges on the way down. So the short-term portfolio would have it would flip. Like right now, the long-term portfolio has 1.5 million, and the short-term portfolio has 700,000. What would happen is it would flip, and the long-term portfolio would have 700,000, and the short-term portfolio would have 1.5 million. But the great thing about that is that then we can take the cash in the short-term portfolio and double down on these positions, right? Because think about what I'm saying. Right now, this is 1.6 million, and the short-term portfolio is 700,000. If the market does, we have $1 million worth of hedges. So if the market drops 20%, that's where we pay off. If the market drops 20%, we get $1 million from our hedges. Basically goes to the short-term portfolio. That makes the short-term portfolio $1.7 million, while the long-term portfolio maybe goes to 800,000, because we'd have a lot of short puts that we'd be responsible for here. But then when we consider it a market bottom, we would then take the $1.7 million cash from the short-term portfolio, double down on the long-term portfolio. And if the market does what it keeps doing, which is coming back from that drop, we would then have $3.2 million when it recovers. So if all this stuff, if all this stuff dips and we double down on it all and then it recovers, that's how we get to 3.2 million. And all we need to have happen is this kind of dip that we've had twice already in the last 2 years. Is this one of these or one of these? That'll do it, or that'll do it. So we come back to $2,600, and our plan, boom, kicks right into gear, doesn't it? And that's how that's why it's worth still playing. Even though we know we're going to take a massive hit in the long-term portfolio. If the market really crashes out, we'll get hit really hard. Still, though, all of these positions are ones we'd love to double down on. There's no companies in here that we want to abandon. And especially if the only reason they're going down is because the market takes a hit. And by the way, when I say takes a hit, I mean not because somebody nuked New York. If something horrible happens, that changes the landscape, right? But assuming it's just dumb stuff like we are doing now, like trade wars in China, so on and so forth, if the market slips and goes all the way back down here to 2,400 on the S&P, instead of, here we pretty much rode it out. We did get aggressive with a bunch of positions in December. We did flip long. We made a lot of money. It was a very good time for us, actually, but we didn't get super duper aggressive because we weren't rich then. Because our portfolios were only, they were only 1.4 million then, or something like that. The LTP, STP. Now we're up to 2 million, 2.3 million dollars in the two portfolios. We're doing great. And even if we take a hit and we go down to 2 million, 1.7 million, I feel pretty confident shuffling the money around, getting bullish. And if we double up from there, we'll go to 3.4. That's how it works. You take advantage of the dips, but you can't do that if you're not set up to take advantage of the dips, and you're set up to take advantage of the dips by hedging and diversifying. And that's what, and it goes back to, again, that's what this is all about. When you look at us building this hemp boca portfolio, it's really no different than the long-term portfolio, the short-term portfolio, the options opportunity portfolio, and especially the money talk portfolio, which is already up 170% in not even 2 years. Because that's all we do. We start from scratch and we build and we take advantage of the dips and we build again. It's just the same thing. And you just got to get into the rhythm of it. And the rhythm of it, though, plays out quarter by quarter by quarter, not day by day by day. And I see so many people still over trading and overplaying things. Whereas really what we're doing here is selling a lot of premium, letting the premium expire, which takes a year, 2 year periods of time. So otherwise, we're basically just waiting. When a bargain comes up, we add the bargain stock. When we think something's out of position, we play it a little differently and we'll add to it. And yes, sometimes we're wrong. Sometimes we have positions that don't pay off. It's still a long-term portfolio. Here's Helios and Matheson. Here's we have Frontiers in this portfolio somewhere. We've got here's Frontier, big hit, $54,000. It's not that this is a foolproof plan. ALB, who else is bad? We don't have too many bad boys, actually. Oh, here's Best Buy, could be better. Wow, not too many big losers. You gotta really look. Here we go. Here's Macy's. Macy's a big loser, but I love them. So happy to put more and more money into Macy's. Anyway, all right. Well, wow. Really, it's hard to find things that aren't going well. Here's one. WBA, Walgreens Boots, another one that's stupidly underpriced. So for the most part, the ones that are not doing well are ones that I think are crazy low. Anyway, the bottom line is, though, yeah, we have some turkeys. You're going to have some turkeys if you're going to pursue this kind of strategy, but the very, very broad diversification that we have protects us from getting too mangled up by one thing. And the main thing is that we sell a ton of premium and we keep making money as long as the market doesn't go down. As long as the market is basically flattish, we make a ton of money on the premium we sell on the short put side and the short call side. But that's what it's meant to do. It's meant to grind it out. We're not day trading. We really don't day trade anything. Even in the short-term portfolio, it takes months for those things to play out. Those who have short-term positions are month, 2 month, 3 month positions. We don't do day trades. Nowhere in our portfolios. The only day trading I really do is the futures because you get in, you get out, you're done. But I haven't played the futures. How long has it been since we really played the futures? It just hasn't been obvious. I only like to play the futures when I know I can win. So lately, it hasn't had any really good setups. All right, so no other questions. Oh my God, I must be so interesting or so boring. One of the two. Either everybody is enraptured by what I'm saying or everybody is asleep. One of the two things. But anyway, what I'm trying to say though is that, watch us build the Hemboka portfolio. But there's no difference between the Hemboka portfolio and the long-term portfolio or the options opportunity portfolio. It's, I know it's boring. It seems boring, but it's not. It's just a matter of adjusting your expectations for how long these things will take. It's the same thing when you get into like home building. If you're into like investing in housing, right? You put up some money and nothing happens. And then you put up some, and then they need some more money and nothing happens. They need some more money. Finally they get a foundation. It's all done. The permitting process is over. They put a foundation in. Then some guys come and work, and then 6 months later you're looking at the thing going, why isn't this thing finished yet? And they've still got like a ton of work to do on the inside. And you're like, oh my God, this will never get done. Then it finally gets done, and you sell it, and maybe you originally put in $400,000 and you sell it to $600,000. You make $200,000, 50%, and the whole process took less than a year. That's a good business. It's not exciting, it's slow, it's tedious, but it's a good little business if you buy in the right places. It's also like PSW Investments, because PSW Investments starts these projects that take a long time to play out. They take years, but it's not a hard concept like the Judgment Search Network that we invested in. We're probably about $150,000 into it at this point, I guess. It's still not producing any income, which is very frustrating because we are actually months behind schedule now. But we're months behind schedule not because of anything really bad, just because of data that we can't get because the states, they did this thing with the licenses. All the licenses now have to have, I don't know, some kind of new security thing that all the states have to comply. So Jersey had to comply, and it caused them to shut down everything that they were doing, including providing us with data and do this project for the licenses so they'd be in compliance with the national security. Anyway, bottom line is, so through it's the same thing as the stock. Through nothing bad that the company actually did, the project has been delayed by 6 months, and that's frustrating. But the bottom line is, in the grand scheme of things, that's not the point. The project is on track to pay back maybe $250,000 every single year off that $150,000 investment. So forever, from now forward, we'll make back more than 100% of our money every single year. That's a worthwhile investment, even if it does take a while to kick in. And the same thing goes with the Hemboka and with the New Age, the marijuana company in California. It's just, it takes time to get permits and equipment and so on and so forth, and then you've got to get customers and contracts and whatever. But eventually, cash starts flowing back in. And then you're very happy, but it takes time. And these portfolios also are cash flow machines. And frankly, one of the reasons I wanted to not close the long-term portfolio, usually we close our portfolios after they make 100%, I'm done. But it's silly. After you make 100%, all the positions are mature and you shouldn't have to worry about them. The reason I wanted to do it, though, is because we don't follow through to the point where these positions become money-making machines. And And that's what happens, because as these things expire, what's going to happen is, Whirlpool's at 146 and we have the 100 calls. So in 2021, we're going to roll our 100 calls to the 2023 whatevers, and we'll sell some short calls, but we'll probably build a bigger position, because as these positions mature, we move more towards, see here, we sold the 140 calls for $5,000, and we're up a tiny bit so far. As the positions mature, we get more and more into the call selling. So the long-term portfolio starts to look more like the butterfly portfolio, and because we have millions of dollars in positions, we'll be able to sell $500,000 worth of premium every year just in short calls. So we'll start bringing in from a portfolio that started with $500,000. We'll be selling $500,000 worth of puts and $500,000 worth of calls. So $1 million of premium we'll be selling every year. So we're getting 200% returns on our original investment every single year going forward. And this is what you want to build for your children and for your family. Not a portfolio that pays off once, but a portfolio that will from now on generate an income. And that's also, as you'll see, we're going to put more and more money into these dividend paying stocks, because again, it's an income. For the dividend positions, we also sell puts and calls against, but we get the dividend income, which right now, just the positions we have now are paying us like $75,000 to $80,000 in dividends. Not just these, there's some down here too. Like Ford, see, it's Ford. So we're getting $75,000 to $80,000 in dividends, not counting the short puts and short calls, which are 2, 4, 5, 6, 12. 12 and 4 is 16, 24, 20, 30, 45. So there's 4,500 plus down here is probably another 5. So maybe about $50,000 of short puts and calls, and it adds up so fast, right? That was just 1, 2, 3, 4, 5, 6 positions. So 6 positions was like $4,500, and as I said, it's probably about 60,000, counting the other spreads we have. So you have that, then you have 80,000 in dividends. That's $140,000 just coming in off your dividend stocks. And again, a portfolio that started with $500,000, paying $160,000 or whatever in dividends and calls, and short calls, or $140,000 dividends and short calls. That's 30% every year back. That anybody can run a portfolio like this. There's nothing complicated about this. And frankly, you could stop selling short puts, and obviously you give up half of the money. You give up about $20,000 to $30,000 of it. But then you would just only sell. Calls. It's very easy instructions to give to anybody in your family, right? Just sell calls every quarter against this. Just sell calls every quarter against that. Collect your dividend checks as you get called away, buy the stock again and sell more calls. Not complicated. The point is that what do you want to accomplish with your portfolios? What do you want to accomplish to make money? What's the goal here? And if the goal is just to make money for yourself and whatever, then fine, go ahead and day trade and do whatever. But you're not building anything that lasts. You're the trader. I'm like that too. This is why I'm building a hedge fund and stuff. My kids, I originally thought my kids would want, I thought one of my kids would want to go to trading. No such luck. Neither one of them has any interest at all, which is a shame. But they're not going to carry it on. But meanwhile, so what am I going to do? Well, how am I going to make sure that they're taken care of in their life? How am I going to make sure that their kids, my grandchildren, not born yet, are going to be taken care of in life? And it's to set up something that's going to have an ongoing collection of wealth. So I wanted to start PSW Investments that'll just keep making money with different companies and so on and so forth. I want to build a hedge fund that has a portfolio of stocks that can be run. I don't run the hedge fund. Doug trades a hedge fund, so it's the same concept. I had found a guy who can run a hedge fund and do a good job and take care of it and manage the investments. And we talk all the time, but run it in the way we need to run it. We can train other people to do the same thing down the road as it gets bigger. And we'll have more traders and so on and so forth. That's what Goldman Sachs is. It's a giant hedge fund. You want to do this with your portfolio, so you want to be able to do this for your family down the road. Not just the short-term making money, but a long-term security, a thing of value. Make your portfolio something of value that will last for generations, not just, while you're watching it. And that's what we're building here. And every time we convert some of our cash into one of these positions, that we have 20, 45, 55, 60, 70, 100, 160. There are $160,000 worth of positions here, and then more below, I'm sure. So maybe a couple 100,000 in positions. So, again, it's 40% of what we started this portfolio with 18 months ago. 40% of our $500,000 is now in dividend-paying stocks. Eventually, it'll be 100% and 200% of our original 500,000 is going to be in dividend-paying stocks, and plus all the cash and all the other positions. But long term, it's these dividend-paying stocks that are going to sit there and be an annuity for our entire family for years to come. And that's what you want to build if you're building a portfolio. Build something that's going to last. And the short-term trading is never going to last. It's going to win when it wins and lose when it loses. But it's not going to, the real reward is in building something. It's going to be substantial, and it'll pay out long after you're gone. We all should think about that. It's not just your retirement. It's your retirement and then taking care of your kids and then taking care of their kids and so on and so forth. And you can set up trusts and do all these things. And what else can you do for you? What better can you do for your family than to leave them something where they're going to not have to worry about money and such? So that's what I want to demonstrate here. And that's what I'm trying to build. And that's what we're building. Whenever we make new trades, whenever we start these new portfolios, that's our goal. Is we're moving towards that. And I want to get people more into this kind of trading, this kind of investing. All right, and last thing I'm looking at is a question. It's not really a question. RS says, check CL. What are we checking in oil? What's happening? Oh dear, gave up a lot of its gains, all of its gains. That's weird. Had a huge draw. Oh, when did this start? 1 o'clock? Oh wow. So what is it? What was in the EIA report? That's interesting. Let's see. Is this a new one? July 19th. Yeah, that sounds right. Okay. So imports average. Oh, hang on. Control plus. Okay. All right. So we know there's 10 million barrel draw. Blah blah blah. So what happened? We have oil down 10 million barrels, check. Motor gasoline flat, check. Distillates flat, check. All other oils are up 4 million, so there's some of that taken away. SPR flat. So on the whole, there is a 7 million barrel net draw out of the total inventories. We exported less. I'm not seeing what they're talking about. Production for refineries, same. Product supplied, basically, same-ish. Same. Just a little bit more here, but nothing exciting. We exported a little bit less. It's not just a little, it's 2 million barrels. It's 300,000 barrels a day less was exported, so that accounts for 3 million barrels of this build. I'm sorry. 3 million barrels of build here. So it made it rougher for them, and we still had a nice draw in oil. So I don't see what the problem is. I'm not sure what people are freaking out about. There must be something else driving it. It's got nothing to do with the inventory. But on the other hand, we already had a run up, and I guess, it's hard to say what's causing that. Where's the dollar at? Dollar. Dollar came up a bit, but not much. Yeah, that's pretty weird. I don't know, did you see something that caused that? Twitter, let's see what Twitter has to say. Oil. Saudi Arabia is exporting more oil to China. Okay. That's from the EIA. Oh, what's this? Global oil market is in a glut. There you go. So that is that kind of report. OPEC has shifted the goalpost for assessing. All right, so OPEC is so in other words, there's a glut of oil, and OPEC is trying to just basically redefine it and say it's not really a glut, which is not good because that means they're less likely to take action to reduce the glut by denying it, which is kind of like climate change, right? Like you pretend it's not there, so you don't do anything to fix it, and it gets worse. So that's where we are with oil now. What was that? Standard oil. What? What does that have to do with it? Index is oil production. Wow. Oh, and the hurricane. Oh, okay. So they're saying the hurricane shuts down the production now. So yeah, we're pretty. This is us. This is us making 12 million barrels of oil. Look at that compared to like 2 years ago. So we're now making 12.5 million barrels of oil pretty much, or 12.25 million barrels per day, U.S. production. That's pretty impressive. Oops. Anyway, if I had to guess, I would say that's probably what it is. So it's probably the gist of it is the fact that OPEC is redefining what a glut of oil is. And by doing that, what they're doing is saying, they're saying we're not going to act to reduce it until it's worse, and that's obviously not a good thing if you want to support the prices. So, but you know, it wasn't. I think it was just basically a little gut reaction thing there. But on the whole, it was a good draw on oil. There's nothing in the EIA report that says it wasn't. And I wouldn't be looking to change any. Look, we're not really long or short in oil right now. I think our gasoline is expired, didn't it? Where do we have gasoline? The options opportunity portfolio or short term? Yeah, UGA. So UGA is done. Where did that finish? Nope. La 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 la. UGA. So that finished at 30.40. So that was not a good finish for us. So we have the 29.32. So we finished 140 in the money here. And we have the 32 puts, which I forgot what we said we were doing with them, but we did something with them. So soybeans are in the money, though. That's good for us. So we'll see. So UGA finished off better than it looks, but not fantastic, not perfect. Anyway, so we have no positions that we care about changing. So there's nothing to it. I'm neither bullish or bearish on oil and gas at the moment. And I did just say earlier that I thought we should play NG off of this line, the 250 line. So we went long in chat earlier, 250 on NG. And that's just a Z19, that's just for the December contract. So we're hoping the hurricane season, something happens in hurricane season, but this is a good support line, so it's good to play. And if you make a quick nickel, that's good money. So just take it and get out and be happy. All right. So Mueller's resuming for his last half. I'm going to go watch that. You guys all have a lovely, lovely week, and we'll do it again next week. Okay. Thank you very much for coming.